All right, all right. It's episode number 39 of The Rent Roll, your podcast on all things rental housing, apartments, SFR, and BTR. And today we're going to talk about all three. First, we got to talk more about Q2 apartment leasing and rent data so far as we as we near the end of the second quarter. I talked about this briefly in last week's episode, but I want to dig into this more, and here's why. Like many of you, I was out at the National Apartment Association's Apartmentalize conference in Vegas last week, and I'm the kind of research nerd that I can't look at just a spreadsheet or a dashboard for market trends. I got to talk to people, and so in this case, that means talking with operators about what they're seeing on the ground, what they're hearing from their on-site teams, how they're feeling about the market, and so obviously had a big gathering of operators at NAA last week. And, anecdotes aren't everything. I don't like to put too much color in how people see and what people see and think. But I do believe that when you marry together hard data with soft color, you can better understand the market. So I'm going to share some color and some data and some theories on where the market is right now and where it's going. Is demand cooling off? Is the mainstream thesis of improved rent momentum in 2025, is it going to play out? What data is worth watching right now to kind of gauge where the market is and where it's going? So we'll get into all that. And then we're going to shift heavily into SFR for the second half of today's episode. I'll be talking with David Todd, a managing director at Brookfield Asset Management and also the CEO of Brookfield-owned Maymont Homes, a national portfolio of more than 20,000 single-family rental homes. And what drew my attention to Maymont and Brookfield is that they put out a brief but very thoughtful white paper on forecasting SFR performance and identifying growth markets for investment opportunity. And it really stood out to me because it wasn't the typical, hey, here's our thesis and here's some data to support it. We see, I don't want to generalize. There's of course, there are exceptions to this, other groups that are like Maymont out there. But for the most part, we see a lot of, hey, I'm going to lead with the thesis and then cherry pick data to support it, right? And but like some of you, Maymont's a very data-driven group. And so instead, this white paper is all about, hey, we're going to lead with the data. And here's how we think about identifying markets with opportunity. And so that's why I wanted to talk to David. And I'll be talking to him about their approach, as well as the Maymont story and what strategies they're pursuing in SFR and BTR right now. All right, before we jump in, I want to give a big shout out to our sponsors. First, to JPI, a leading apartment developer with the purpose to transform building, enhance communities, and improve lives. So thank you to JPI. And also thank you to Waymaker, multifamily investment group focused on Class A market rate apartments, as well as attainable housing, partnering with best-in-class apartment builders across the Sun Belt. All right, so as always, kick it off with here's a chart, and we got a lot of charts for those of you watching the video stream. And if not, I will talk you through it. When I first started this podcast 38 episodes it is, now we're in 39. One of the first feedback items I got was, hey, Jay, you got to tell us on these charts. Most of us aren't actually looking at these screens. We don't want to see your face. Just want to know what you're talking about, all right? So I'm going to walk you through that, okay? So this first couple, this is going to highlight, just briefly recap some things I talked about last week. And so the headline was rent growth has stalled these last couple of months, despite the fact that we've still seen good demand. And so rent growth year over year had been accelerating for 6 consecutive months, peaking in this cycle last couple of years in March, topping 1% for the first time in 2 years. And then in April went down a little bit year over year. And then in May, again, down a little bit. It's not a dramatic drop off. That's 2 months. 1 month to kind of take with a grain of salt. Back-to-back months at a time when we typically see acceleration, not deceleration, that starts to be a little bit interesting. That starts to be worth talking about. And then what was really interesting is that when we looked at this in the high supplied Sunbelt and mountain markets versus the Midwest and coastal markets, what we noticed is that it was a similar trend all across the country. So it wasn't just about supply. Now, in the higher supplied Sunbelt and mountain markets, we did see we already had been seeing rents falling due to this massive wave of supply, but the pace of rent cuts had been moderating through March. But then April and May, we saw rent cuts on an effective basis started to become a little bit more significant. Again, not dramatic, but enough to be of note. But then also in the Midwest and coastal markets where there's less supply, and we've generally seen better rent growth these last couple of years, we had been seeing this upward trend in rent acceleration, and then kind of the same trend. We've seen it stall out. It's not further accelerated. In the combined coastal and Midwest regions, we're around 2.5% year over year for the last 3 months. So it really, again, hasn't yet kicked into that next gear. And then going back to the Sunbelt and mountain markets, what's really interesting is that we've seen increased concession availability among stabilized properties. These are non-lease ups, and so this chart, for those of you watching this, is showing you the average concession value among stabilized apartments in the Sunbelt and mountain regions, and it went from about 9% of asking rents in March to now about 10%, and so that's more than a month free rent, if you think of it in those terms. And that's that's actually, doesn't sound like a lot, but that's actually a pretty significant jump up, especially for non-lease up properties. And it's the highest it's been in this cycle. And so I think what we're seeing is that operators, they want to stay full and they're increasing concessions to not have to move their base rents in order to draw in demand, or at least to attempt to draw in demand. So that's particularly interesting. It's not necessarily they're cutting rents more, but they are offering a lot more on concessions, and that's what's impacting those effective rents. All right, so what's driving this? Okay, well, first of all, let's start with what it's not. Is there a lack of demand? And I've looked at this every which way. And at a macro level, there's not a lack of demand story here. There's plenty of demand. Q1, we talked about this earlier, was the second best Q1 for net absorption in 25 years, according to CoStar. Best Q1 in record in the last 25 years, according to RealPage. And second thing you'd ask is, okay, and by the way, looks like to be similar story for Q2. Still very good demand so far. But then you look at this, okay, is it a flight to affordability? Are we seeing demand shift down market? CoStar is tracking demand by asset class. And what's interesting is that, no, there's not been a flight to affordability. In fact, it's been the opposite. It's been more of a flight to quality. And we see renters moving up market, not down market. The Class C demand has actually been slightly negative over these last few years. And I've talked about filtering in the past, but we see very clear evidence that the higher income Class C renters are moving up market, not to the brand new lease up necessarily, but to a Class B property, as the B renters move up to A minus move up to the A plus new lease ups. That's having this filtering effect down market. So Class C is still taking it on the chin as a result. All of the demand, all the net new demand is Class A and Class B. And the biggest chunk of it is going to be new lease ups. And so again, even if your occupancy rate is not moving, that doesn't mean it's not demand in the market. I think this is where a lot of people get tripped up if you're on the operations side. It's just because you're not seeing it or feeling it at your individual asset, your portfolio, doesn't mean that demand isn't there. We've built more than 1 million new market rate apartment units over the last 2 years. A lot, and while those lease ups are not brisk, they are still leasing up, and so that's gobbling up most of that net new demand. But again, I think the good story here is that, generally speaking, vacancy rates are still pretty stable, which you get to in a moment. The other thing that's important and kind of related, I alluded to this earlier, is that there's really no sign of weakness in affordability trends, at least among market rate renters signing new leases. In fact, counter to the headline narrative, affordability is actually emerging as more of a tailwind than a headwind for market rate apartments as well as SFR. Wage growth has been outpacing rent growth for more than 2 years. That means declining rent income ratios. We're back around 22% so far in 2025, which is pretty much in line with the pre-pandemic norm. So that's something we'd look at. If there was a sign of a slowdown, we should see it in the affordability numbers. We might see it in a flight to affordability in terms of demand shifting down market. We might see it in terms of renters doubling up. That's not happening either. And then, of course, another sign of a slowdown would be more move-outs. That's not happening either. We've talked about this a ton. There's no sign of weakness in the renter turnover numbers. Renters continue to renew leases more and more frequently. We've had 18 18 straight months of year-over-year increases in the apartment retention rate. So on a T12 basis, we're now north of 55% retention nationally in market rate apartments. The only time in the last, probably in history, but at least in the, 10 or 15 years, if we have data for this, we've had numbers above that, was during the inflationary peak of 21 and 22, back when vacancy was record low. So there's really nowhere else to go. And rents were up by double digits. So, renters had few alternatives back then. The best option was often to renew. But today, your Class A and Class B renters, they have plenty of options. They have plenty of alternatives, at least in most markets they do. Maybe not in every single neighborhood across the country, but in most markets they do. You can chase concessions, and in some cases, even with moving costs, you might be better off financially just to move to a comparable or even a better property at a lower rent. But most renters still aren't doing that. They're renewing their leases anyway, even if they're economically incentivized to move. And I've talked about this a lot before. I'm not going to dive into all those reasons. If you're curious, you can. I did an episode a while back on why retention was so high, and also talk about this a few episodes back when I talked to you about the apartment REIT earnings call recaps. I hit on this theme as well. So I won't recap all of that here. But again, bottom line is, renters are renewing their leases, both in apartments and SFR, and it's not just because of fewer move-outs to home purchase. It's a common misunderstanding. There's a lot more to it than that. So again, tying this all together, we've had slowing rent growth, but it's not because of rising vacancy. Vacancy rates are still modestly above normal, but not dramatically above normal, and they're also steady. They're not really, they're not dramatically increasing. We've seen vacancy rates kind of steadily around 6% or so, depending on who you ask, 5 or 6%. It's been pretty stagnant over the last year and a half or so. It just hasn't moved that much, and that's a good sign. Even though we're nowhere near the vacancy lows we saw a few years ago, the peak of inflation, the numbers are also nowhere near the record highs that we saw during the Great Financial Crisis when it was around 8%. So it's been a pretty decent story considering that we're having apartment supply competition at 40+ year highs. So that's good. And then, I think what really makes people nervous, though, is they see traffic, apartment traffic, or leasing traffic, guest cards. And these numbers have been pretty stagnant. In some cases, they're even down. Radix had an interesting report showing that traffic's been down, but lease conversion rates have been up, or actual leases have been up. And we're hearing that a lot lately, is that traffic's been flat or down slightly, but not bad. It's not going up as much as you might want to see, especially in leasing season. But the conversion rates are very good. Generally speaking, we're seeing qualified traffic that's enough of it, at least, that's converting into leases, and that's a good sign. So what's going on? Why aren't we seeing maybe better traffic, and why are we seeing rent growth numbers come down a little bit? So I mean, again, I alluded to this earlier. Is number one, again, remember there's a lot of demand, but it's still being spread across greater number of properties, and so that's going to kind of feed into the theory I want to share with you here. So again, looking at all the data, talking with operators, my sense of it is this: okay, with new supply waning, coming down, I think a lot of property managers and property owners, asset managers, they were looking at those supply charts and they said, hey, look, supply peaked last year, it's coming down. And so they're thinking, okay, leasing season starts, we should be able to see strong leasing activity and occupancy rebounding in the peak leasing season, starting in Q2. And so I think, expectations for Q2 were, and I didn't probably realize this until talking to some folks in Vegas last week, that they had really kind of high expectations for a rebound in Q2, and that hasn't happened. I guess, again, I'm generalizing here, speaking high level. Obviously, some of you, this may not be the case for, so let me just throw that caveat out there. But we haven't. I don't think the leasing traffic numbers and occupancy numbers have maybe met the expectations, but I also think those expectations may have been a bit too optimistic, or at least too premature. And so with that not happening, I think we're seeing operators are nervous. And so rent growth isn't accelerating like it normally would this time of year. But again, the apartment market's still in healthy shape. Macro demand is strong. Rent-to-income ratios are improving. Occupancy rates are stable. No sign of doubling up or flight to affordability among renters. No traditional signs of a slowdown of any sort. But, one thing that has changed maybe a little bit more than we thought was leasing traffic. or at least more than expectations. I think there was a lot of expectations. We see strong leasing traffic, really a rebound of leasing traffic in Q2, the start of leasing season, and that really hasn't played out. It's generally been flat across most of the country, maybe down in some parts. Radix had an interesting report showing that leasing traffic in some cases was down, but that actual leases or conversion to leases was up. And so, in talking to operators, hearing the same thing is that even though they may not see the big traffic numbers they want, they're still seeing enough qualified traffic that's converting into leases. And so that's what really matters. And that's why, in addition to strong renewal demand, is translating to still those steady occupancy rates. All right. So that kind of leads into where I'm going with this. So as I've talked to operators, I think one thing I've learned is that there were some pretty bullish expectations for Q2, and I think that's maybe that maybe explains some of the lack of, or the rent growth deceleration these past couple of months. I think is partly due to maybe some undue expectations for how fast this rebound would start. So here's my theory. Again, after sifting through all the data, talking with operators, I think that number one, people in the industry got too excited. And again, I'm speaking generally here. Obviously, some of you are going to be the exception, so bear with me with that. But I think a lot of people got too excited looking at charts showing supply peaking late last year. You just assumed, smoother sailing too soon. And while completions did peak late last year, lease-up volumes did not yet. We're still at peak levels of actual lease-ups. It takes time to fill this massive wave of 1 million plus apartment units built in these last 2 years. Plus, many property managers are wrestling with the year two hangover, which refers to those newly built apartments that are struggling to retain their earliest residents. Many of them signed concession-heavy leases that are expiring at the same time that availability in these recent lease-ups remains high. And so, in other words, it's still a competitive leasing environment. But the good news is that, the leasing traffic numbers, again, maybe have not been spectacular. Again, those conversion rates are high, renewal demand is strong, and that's, again, occupancy rates have held pretty steady. So second thing I want to touch on from that, and I think it's related, but also other factors affected as well, is that apartment operators, managers, asset managers, investors, I think they're nervous. They see the headlines around tariffs and increased recession risk, low consumer confidence, and those things have a real impact on sentiment. And I tell people this all the time. I mentioned this last week as well. The hardest variable to measure in rent forecasting is sentiment. The how people who are making the pricing decisions feel about the state of the market and where it's going. And again, I think there's some real nervousness out there. And when operators are nervous, they're less likely, or I should say, let me rephrase that. When operators are nervous, they're likely to err on the side of protecting occupancy over pushing rents. And that's one reason why we see moderating rent growth, even in lower supplied markets with healthy demand fundamentals. I highlighted the case of Washington, D.C. Last week, where the demand fundamentals actually continue to be very, very good. But with all the negative headlines around D.C. and the DOGE cuts, federal layoffs, et cetera, we saw rent growth take a step back in these last couple of months, even though, again, demand fundamentals are fine. So in most of the country, we just don't yet see any of these traditional telltale signs of a slowdown, at least not yet. And we'll see how this plays out. Things could change. But for now, my guess is that, for the short term, for apartment owners and operators, the short term is going to remain a struggle. But if the economy holds up, I think the mid and long-term outlook remain favorable. So I think that mainstream thesis is still intact. As supply continues to wane and lease up, and the economy remains in decent shape, assuming that happens, we should see the market rebound. And I still think it'll happen, just maybe not as quickly as some of you may have hoped it would a couple of months ago. All right, next up, let's shift over to rental housing trivia. All right. Rental housing trivia this week is sponsored by Foxen, a technology-first renters insurance compliance and rent reporting platform that helps you reduce risk and drive NOI. So check them out at foxen.com. And also want to give you a reminder that I will be participating on a webinar about revenue and expense trends and strategies to improve NOI in this challenging market. So you can sign up for that. It'll be later this month, and you can sign up for that at foxen.com. In fact, it'll be next week. So hope you check it out, and it's a free webinar, and hope to see you there. So today's question is, among single family rentals, what market has seen the lowest volatility in rent change over the last 25 years? I'm going to give you 5 choices here. So this is rent volatility. So lowest volatility in 25 years. Is it Chicago, Long Island, San Diego, St. Louis, or Washington, D.C.? All right. So think about that. We're talking about SFR rents, volatility over the last 25 years. All right. Next up in the news. All right, we got a few headlines this week to cover. First one comes from Reuters. It says, U.S. must face claims over pandemic ban on residential evictions. All right, I missed this headline. It actually came out a couple of weeks ago. And let me read a little bit of this to you. It says, a U.S. federal appeals court ruled Friday that the United States must face potentially billions of dollars in legal claims over a temporary ban on residential evictions during the COVID pandemic that affected millions of landlords. The Washington, D.C.-based U.S. Court of Appeals for the federal court, in a 7-3 decision, opens new tab, rejected the government's bid. Oh, I just read my own browser note there, not opening new tab here. No, the article says in a 7-2 decision, the court rejected the government's bid to overturn a decision by a panel of judges last year that refused to dismiss the claims from landlords seeking compensation over the eviction moratorium. Damages have been estimated at tens of billions of dollars as rental property owners were blocked from evicting people who are not paying rent. And by the way, side note, also could be lease violation issues as well. And residential rental property owners sued over the CDC moratorium and federal claims court, seeking compensation over the U.S. Constitution's Fifth Amendment's takings clause. And they argued the government had taken their property for public use. So obviously a super interesting case, and one that's probably not getting the attention it deserves in the industry, but one worth watching. And I think there's a broader question at play here too, for kind of longer term around evictions. And that's, the obvious statement here is that evictions are a lose-lose, right? For renters, they disrupt lives, contribute to homelessness. For owners, they're expensive, they're time-consuming, they bring reputational risk. So the question isn't whether evictions are bad, which I think sometimes the headline narrative makes it out to be, just oversimplifies this issue, but rather around who should fund eviction mitigation. Because if this case ends up moving forward, and if it is successful, then, I think that opens up the door to other claims like this. And maybe a kind of a reframing of eviction policy. Because remember, it's easy to pass a policy. It's easy to pass the buck to somebody else to solve the problem. It's harder to put your money where your mouth is. And I tell people this all the time, as a policymaker, you show your priorities not by what you tell others to do, but what you choose to fund. So the question is, who should foot the bill for renters unable or unwilling to pay rent? And if eviction prevention is a top priority, and there's a good argument it should be, then don't just pass the buck, but fund it. All right, next headline comes from Barron's. It says, May shows no sign, let me rephrase that. May shows no softening in shelter inflation. All right, so this is not the most accurate headline, but it does just kind of bring up, I want to talk about CPI inflation and the role of shelter and rents here. I've talked about this a lot in the past. It's funny. It feels like every month on social media for the past 2+ years, the CPI data comes out, and on that day, on X/Twitter, you have macro economists and reporters posting rents are pulling up inflation, and then the apartment and SFR investors and operators are like, I wish my rents were up that much, but they're not, especially because there's so much supply pushing down rents. So the reality is that CPI rent growth is actually cooling significantly, continues to cool. It's taken a while, it's lagged, but we're back down to pre-pandemic levels. It's back below 4%. Street rents or new leases obviously are much softer. We talked about that earlier. But remember, number one, CPI has an outsized role. Rent has an outsized role in CPI. And number two, CPI rent lags reality. And this is really important because if you're not aware, it's a survey of 6,000 renters a month that helps shape 30% of the total CPI. That's our measure of inflation in our country. A 6,000 renter survey impacts that. So that same survey of renters is used to measure housing inflation, both for renters and homeowners, because that's a lot of people don't realize this, but owner's equivalent rent, which is a bigger variable than rent to primary residence in the shelter metric, combined, that's what makes shelter. It's 1/3 of CPI. It's not a survey of homeowners, as some people think it is. And I won't get into the mechanics of this, but the primary variable in how we measure owner costs in the US is the same survey of renters used to measure rent. So anyway, rent inflation is back below where it was back to where it was prior to the pandemic. So we've got that back down. I think it'll come down a little further as well. It won't come down as much as sticker price rents did, because remember, it's also impacted by renewal leases. All right, next headline comes from the Wall Street Journal. It says New York City just banned broker fees on tenants. Landlords already jacking up rents. Some property managers are expected to test the market by imposing major increases with the new law now in effect. So this is playing out about as expected when New York City passed banned broker fees. It does reduce the amount the renters pay up front, and instead spreads those costs throughout the life of the lease via higher rent. But the article makes a really interesting note here, which is that when you pass those costs onto the rent, those higher costs now stick through renewals. And so it theorizes that renters may actually pay more in the long run. And of course, New York City is such a weird market this whole concept of broker fees is something that we just don't see in the vast majority of the U.S. Just one more sign that New York City, kind of still operates on its, very different planet from the rest of the country's apartment and SFR market. Next headline comes from the Michigan Advance. It says Michigan bills would require landlords to do repairs within 48 hours or renters can withhold rent. So this is interesting. It kind of, as I was reading this, it kind of reminded me of this broader trend that we're seeing, particularly in SFR right now. And so in this one, and oftentimes the target is institutional landlords, but in reality, these are types of bills that really hurt smaller mom and pop landlords who dominate the market the most. Like a policy like a 48-hour repair requirement, that really is going to favor larger property managers with in-house maintenance teams. Even as a homeowner, how many of us can find that it's frustratingly difficult to get someone to do repairs at your own house within 48 hours or a week? And so that's only going to create further challenges for the smaller mom and pops who dominate the market, especially in a state like Michigan. All right, let's go back to rental housing trivia. Our question this week was, among single-family rentals, what market has seen the lowest volatility in rent change over the last 25 years? Chicago, Long Island, San Diego, St. Louis, or Washington, D.C.? And the correct answer is Washington, D.C. It's been a remarkable steady market, usually somewhere between 2 to 4% for SFR rent growth, according to our friends at John Burns. It's never been below 1% in the last 25 years in a calendar year. On occasion, it's top 6%, but it's generally pretty steady. And yet, DC is basically a non-institutional market for SFR. That's true of most big gateway markets as well. It's just largely due to higher home prices and difficulty accessing the market at attractive yields. So only about 1% of the DC metro area's SFR inventory is owned by large investors with national portfolios topping 1,000 units, according to John Burns. And by the way, I was looking at this top 10 list. It's an eclectic list of markets for lowest volatility over the last 25 years. I'll read them off to you. DC, Des Moines, Long Island, New York City, Milwaukee, Chicago, and then Houston, St. Louis, Pittsburgh, and San Antonio. So maybe a couple surprises there with 2 Texas markets, as well as a higher growth tertiary Midwest market in Des Moines. And conversely, you won't be surprised to know that Florida has some of the most volatile markets in the country for SFR rent growth. They go big, and also they get hit hard. Chief among them is Fort Myers, which has been the most volatile market in the country for SFR rents, according to John Burns, over the last 25 years. All right, that'll take us to the interview, and I am thrilled to welcome in David Todd, a managing director at Brookfield Asset Management and the CEO of Maymont Homes, an SFR portfolio of more than 20,000 homes under the Brookfield umbrella. All right, now we enter the interview portion of today's podcast, and I am absolutely honored to welcome in the head of Maymont Homes and a managing director at Brookfield, David Todd. So, David, thank you so much for being here.
Thanks for having me, Jay. Been a big fan of your posts and excited to spend some time with you.
All right, let's start by getting a little your story. Tell us about your background before you got into SFR and heading up Maymont Homes. What led to that?
Actually, I started as a computer programmer at the consulting company Accenture. I later moved into more process improvement and organizational redesign. I didn't, of course, really even know what single family was or that I would end up in this sector, but it ended up being really good training, which I'll get into. While Accenture had some really interesting assignments, I lived in England trying to modernize their healthcare system. I was part of a small team that set up the Transportation Security Administration after 9/11. Basically, some of us lived in a basement of an airport. Learned a lot about how to set up and improve an organization. So on to real estate. When I was while I was doing that, I had a side hustle, buying and renting row houses in Washington, D.C. They were really affordable then. There was a lot of incentives, and I had a lot of fun doing it, and just found that it was my calling. Didn't have an obvious entry point into the industry, so just tried everything. Cold calling people that rent the paper, learned Argus, the financial modeling.
The hustle. Yeah.
Hustle. That's right. And finally landed a really great job with a good retail organization called the Rappaport Companies. Started off running permits, and it just grew from there. And in a little bit after that, I read a book called Barbarians at the Gates. And for those that haven't read the book, it's about one of the first leverage buyouts and sort of how corporate acquisitions work. It's sort of the heyday of Wall Street in the 80s. And it goes through all of the details and how difficult it is and the complexity of it. And I found it very interesting, and I wanted in. I didn't have an obvious an entry point in there either. It wasn't easy. You had to hustle, like you mentioned. So I went back to school. My family and I moved around a bunch. I got some lucky breaks, and I eventually landed a fantastic, amazing role at Brookfield Asset Management in their corporate M&A group, their mergers and acquisitions group. And in that role, I was able to work on some take privates and lead some larger corporate acquisitions. One of those was Conrex, which is our SFR platform. We bought that during COVID, and it needed some pandemic level attention. So I jumped in to look after that business. And it's been a great culmination of all my prior experiences.
That's a great story. I think everybody I've talked to on this podcast, no one grows, unless it's in the family business. No one grows up thinking, man, I'd love to be in single family rentals or multifamily. But you stumble into it, you fall in love with it, and I love your story. So you mentioned Conrex. Let's talk a little about that. What was Conrex, now known as Maymont Homes. You mentioned acquired during the pandemic. So talk to us a little about how it's grown and expanded under your leadership at Brookfield since the acquisition.
Sure. So when we bought it, it was a scrappy startup with a lot of potential. We carefully observed, came to the realization that we should centralize operations and get more control. After the restructuring, our operating margins improved 10%. We're in line with the publics. We were able to raise bunch of capital and tripled our size, and our residents are happy. We have industry leading Google reviews, and we're still scrappy, but we wanted to grow up a little bit. So we rebranded about a year and a half ago to Maymont Homes.
Well, by the way, I love that you just said subtle mention of Google reviews. It reminds me that it's like even institutional level. You guys care about resident satisfaction, reputation, like those things do matter. I want to get more into that later. But one other question, just kind of set the stage a little bit. Can you tell us any context about portfolio size, markets, kind of concentrated markets, any other context about the portfolio?
Sure. So right now we're over 20,000 homes, about 6 billion in assets. We're in around 40 markets.
Wow.
Our assets have they skew more towards the scattered site model, and we can get into sort of how the business has evolved as the market has changed. But right now we're pretty active in build for rent and some other areas like that. And so maybe 10-20% of our business is in build for rent.
Yeah. All right. So another acquisition. More recently, Maymont acquired Divvy Homes, which for those of you who are listening don't know, they had a rent-to-own model that I think struggled. And these are my words, and I'll put words in your mouth. But I think it struggled to gain traction. And there's been I think a lot of interest in this concept of rent to own, and for good reason. Like people are struggling to buy a house, and so conceptually it seems like a good idea, but I've never seen anybody really be successful with it. So my question for you, David, is it a viable business model, and are you maintaining that model? And if so, how do you make it work?
Rent to own, I would say, is a nice idea.
Yeah.
We're going to support wholeheartedly our current rent-to-own residents, but our chief focus is providing a valuable rental experience.
So, what drew you to that portfolio with that Divvy? Like, what was the play there?
The assets. The assets were very interesting. The capital structure made sense in a sort of prior time in a different interest rate environment.
Yeah.
So it just made sense for us to bring it on. We have the operational expertise to make sure that the business and the portfolio does really well. So we were excited to be able to come up with a structure with that seller and merge Divvy into our business.
Okay, so you can support those rent to own residents, but also have the operations to run the portfolio if for some reason those don't work out at an individual level.
Absolutely, yeah. The Divvy brand, the Divvy company, the Divvy name still exists. We mentioned 100% support those residents with their Divvy contracts, but the added benefit is that we have this large operating platform that can service and take really good care of the residents and the properties.
Absolutely. So you've alluded to this a little bit, but SFR acquisitions, just especially scattered site, that's slowed down. Multifamily the same way, of course. High prices, high rates, lack of inventory in the market. So where are you seeing opportunity? Is it scattered acquisitions? Is it other portfolios? Is it development of build to rent? Where do you see opportunity right now?
In times like these are when you make some of your best investments. Take Divvy, for example. In 2021, where there were a lot more transactions going on, we wouldn't have had this opportunity. We felt the market was strong, in some areas too strong, and we sold half of our assets into that.
Wow!
The pricing was very compelling. That dynamic has flipped, and we're nimble and active, and we're very fortunate to be so well capitalized.
Yeah, absolutely. Well, that's interesting too. Just being, like you said, nimble, because everybody thinks about just acquisitions on the institutional side, but sometimes it's more beneficial to sell, right? And so that makes sense.
And I'd add to that, where you're buying and where you're selling should change by whatever the market dynamics are. So in the prior time period, we were active buying individual homes that traded at favorable cap rates, and we were active selling portfolios which traded at very attractive cap rates. So that was sort of the trade there. And build for rents in that sort of 21 time period didn't make sense to us, largely because they were trading very tight because of debt and strong investor interest. That has kind of flipped, and so where we're most active is on portfolios like Divvy and on build for rents.
And it's just more efficient acquisition too, right?
It's more efficient. And when we were doing the one by ones, it's a lot of work. And unfortunately, we felt like we're getting paid for that value that we were adding. But this is it's more efficient. But either way works. I think more what drives our direction is where the market what the market is.
And you mentioned build to rent. Are y'all looking at build to rent communities, or is it kind of excess builder inventory that you're getting in subdivisions?
We're doing both.
Both.
Yeah. Again, we always just look at it sort of on a relative value basis.
Yeah. So you're agnostic to what it is, just trying to find the value.
That's right.
Yeah. And so related to that, one of the things that you and I connected over is you all put out a really interesting white paper. Let me back up a little bit. Your team's developed a very impressive forecasting model to pinpoint markets and submarkets for investments. You put out a white paper recently, and having reviewed it, I was really impressed by the depth of it. And particularly, I want to be careful I word this, but I think there's a lot of sometimes, I'm going to speak very broadly, obviously a lot of exceptions to this. There's a lot of groups, I think, find data to support a thesis or a narrative, as opposed to doing real research and leading with the data to build a thesis around it. And I know to me, I get the impression y'all are really driven by the data. So what spurred y'all to invest so heavily in modeling and being truly data driven, as opposed to just finding data to support whatever you want to do?
First, thank you. We do spend a lot of time on that, and it is a focus for us. Our belief is that you need to do your own homework. Brookfield at its core is a contrarian investor. And part of being a contrarian investor is looking at the source data, not focusing on the headlines, and coming up with your own conclusions. So that's why we did it. And as we outlined in the paper, we've had great outcomes. During those expansion periods that we were just talking about, a lot of groups were moving into areas, say the Phoenixes of the world. We took another direction. And when we look at the relative values and the relative performance in our portfolio, we're really happy that we did that. And that was all driven by that kind of upfront homework.
Yeah. And for those of you who have not seen this, you can find it on Maymont Homes website. But just at a high level, can you maybe just briefly describe kind of what y'all built?
First, we built an explanatory model. That explanatory model has about 350 inputs. With that, we were able to determine the key characteristics on what would drive rent growth, and that created our predictive model. And with our predictive model, we forecasted out where we think the growth and where the opportunities are, and that forms a lot of our decisions.
Yeah, no, that's great. Yeah, and again, I would encourage anybody who's curious and y'all are generous to put that on the website publicly, because I think there's some good nuggets in there for others to glean from. So again, you can find that on the Maymont Homes website. So with that data-driven approach, what markets do you like right now across the country? Like what's sort of fitting that buy box?
The Midwest is interesting. It's always been a focus for us due to the consistent growth that it has, and it's a good place to do business. Right now, it's even more interesting. It has the right amount of new supply, low volatility, and there could be some surprise with the onshoring movement. Regarding, opportunities maybe in the future, there are areas that currently have headwinds. I think a lot of markets in Florida. There's near-term challenges that are presenting opportunities, so we're active there in some facet as well, and we're just making sure that we appropriately underwrite the opportunities.
Yeah, that's a good point.
What are you seeing from all your research?
Well, I was going to ask you, kind of related to that, is that it seems like right now it's a question of there's markets that are currently challenged, but long term you have to really like the demand drivers. You mentioned Florida. I think a lot of the Texas, Carolinas, parts of Georgia, Tennessee, that kind of thing. But also, I think just the steady eddiness of the Midwest. We've talked about this on both the SFR side. The SFR REITs have talked about it. The multifamily business is talking about this. There's not a lot of institutional capitals there now. It's starting to get there. But one thing I wanted to ask you about, kind of as a related question, is one of the challenges I always hear about the Midwest, whether it's SFR or multifamily, is the lack of institutional grade product. And even a single family rental side, like there's just older homes generally, and for the most part the institutions seem to prefer newer vintages, easier to maintain. So are y'all like, how do you kind of balance and if I'm right here, first of all, is there, do you see that challenge, and how do you balance that with trying to find assets that you really like to kind of fit your buy box?
We focus on the location first, knowing that we can renovate product if we like it. We have that capability. So that's probably a bit more of where we go, worth vintage or some of those other, again, kind of maybe just high level criteria that people focus on, and we'll build as well. So we just lined up a really fantastic opportunity in Cincinnati as an example. So that's a situation where we're going to be in an older neighborhood, close to downtown, a lot of positive fundamentals, and we're going to be providing new product for rent in that area.
That's great. And see, I think that's a good example of like a real data-driven approach. Like you look at a market like, well, let's pick on Cincinnati. It's like, it's not that they have the best job growth in the country, right? It's not the best population growth. And there's a good story there, right? But it's more of a steadiness. And you have on top of that, you have a market where most of the housing inventory is very old. And so I imagine if you're going in there and able to build something in a good location, in a good quality newer asset, I imagine you probably don't have a lot of competition.
We think those markets have the right amount of new supply. So you can see where it's coming, a little bit different than doing, say, a greenfield deal in an outer ring of Dallas, which may be great, but you also probably don't necessarily know who all of your neighbors are going to be in the fullness of our investment period.
Yeah, no, that's very true. Now, let me ask you kind of a harder question here. As you get into looking at different markets, obviously there's some things that even the best models can't fully capture. And I would put regulatory risk in the evolving regulatory environment as kind of one of those variables. And obviously, we don't need to get into details here. I mean, SFR and multifamily, especially SFR, is, gotten more of a, regulatory focus around it. So how do you think about the regulatory environment in terms of how does that impact your acquisition and development decisions in specific cities?
We should always be a good landlord, which we are, and we should go where you're wanted, which we do. I don't know if that dynamic has really changed that much, but as it relates to the evolving environment, and kudos to you for doing this, because when you write and you put out the truth of what's going on. We as an SFR industry are doing more to get the word out, and we need to do more to talk about the positives that we provide for these communities. We're an affordable option. We provide flexibility. We give folks an opportunity to get in their preferred neighborhoods, which helps social mobility. And my peers in our trade organization and our NR8C are being much more proactive about that, and I like the progress we're making. But I think that's probably the biggest change that we're taking on right now as it relates to the evolving environment that you noted.
Yeah. Let's just talk about that one more. You alluded to this earlier too, the Google reviews. So I wanted to ask you and I think most people who listen to this podcast probably know, kind of truth versus fiction here, but, what type of work has been done to really, to make an effort to really take care of residents, improve those scores? I mean, can you share a little bit about kind of what Maymont does that to really focus on the resident, make sure like you said, being a good property manager or landlord, and how much that matters?
Yeah. So I would say, to take a step back, it really starts with focusing on your teammates within the company, because when they're happy and motivated and aligned with the mission and really glad to be part of the organization, they'll often take better care of the residents. And when the residents are well taken care of, they'll leave positive reviews, which makes it easier to lease and improves their operating performance. And then the investors are happy. And then when the investors are happy, they're more apt to invest money into the business. So that's sort of the circle. And it all starts with the teammates and the folks that we work with every day. And then that chain reaction is a result of that.
Oh, absolutely. And I've noticed this all across the industry. SFR multifamily is everyone's talking about how, payrolls have skyrocketed, it's getting more competitive to find people. But, I think you nailed it, which is I think the industry at large, all sides of rental housing, the institutional and also the just kind of, I think, large portfolio level, anybody who's 5,000 plus or whatever you want to call it, they realize you've got to invest in the people. I mean, it's been crazy. Like in the past, you've got millions of dollars worth of, whether it's a big portfolio home. I mean, these are portfolios and assets worth tens of millions of dollars, or in some, 600 billions of dollars in a portfolio, but you have individual regional managers overseeing tens of millions of dollars. And, it's somebody who is typically, I'm trying to figure out the right word here, but somebody who's not particularly well paid, right? And now I think we're seeing much more investment in the people. So I'm glad you mentioned that. I think it's really important for everybody in the industry to understand you've got to invest in the people who are running these things.
I agree. It starts there, and I hope that everyone that we work with really likes what we're doing and is happy to be part of it.
So we'll go back to renters for a minute. What's the profile of your typical renters in your portfolio?
Everyday Americans, teachers, nurses, working trades. Some stats, about 22% rent-to-income ratio, and the majority have kids, pets, and like to be in nice neighborhoods with fenced yards.
Yeah. So do you have any idea, like an age profile? Is it mostly people in their 40s with kids?
Yeah, around 40, later 30s.
Later 30s. Okay. Yeah, makes sense. And so you mentioned like being in nice neighborhoods. I have a theory I want to run by you on this. This is a kind of a pet topic of mine. I think there's so much focus on, SFR renters, people who want to buy a house but can't. But I think it's a little more nuanced. I think SFR renters, a lot of them at least, they're prioritizing the ability to live in a preferred neighborhood over the ability to buy somewhere else. Meaning, like, I can afford to buy in neighborhood X, but I don't want to live there. If I see the median home value in a market, that doesn't really matter so much, that neighborhood. So I don't want to live in that neighborhood. It's too far from where I want to be, or it doesn't have the amenities that I want in terms of, services and shops and restaurants. I want to be in neighborhood Y, which has good schools, has access to places that I eat, shop, work, et cetera, but I can't afford to buy there. And so I'd rather rent there than go buy somewhere else where I can afford it. And personally, I think that defines a large number of SFR renters. And that's why a lot of investors tend to prefer these, more, these neighborhoods that have access to good schools and other things to do. Am I right? Is that a fair statement?
You are right, and I do agree with you. I'm in South Carolina a lot for work. That's where Maymont's headquartered, and I rent a house there. From a financial perspective, it makes a lot of sense. It's close to where I want to be, and the flexibility is great. So I'm a case in point of your theory.
Yeah. And I think that's impactful for investors too, of like, understanding that it's you're servicing, particularly at the, the more affluent renters, they're paying 22% of income on rent. Like there's a type of, not just the asset, but the neighborhood they really want to be in. All right, let me ask you another question. Another one's kind of counter to headline narratives. Our mutual friend, Dallas Tanner, the CEO of Invitation Homes, he was a past podcast guest. And in his last earnings call, he made a statement that I just wanted to shout from the rooftops. And I'll just paraphrase here. But he's basically saying that he strongly believes that SFR, the SFR industry benefits from a healthier for sale housing market, that when homes are selling, prices are rising, people are buying homes, that there's a positive correlation to asset values in the portfolio, but also a positive correlation to rent growth, household formation, rental demand, rents. Do you agree with Dallas?
Dallas is the man, and I do agree. I would add that those transactions that you guys were both referencing add a very positive multiplier effect on the economy. And by that, I mean when people are buying and selling homes, they're hiring movers or going to Target to get pillows, and that all compounds, which is beneficial for the economy and beneficial for our business.
Amen. Yeah. Yeah. I'll tell you, everybody's listening to SFR multifamily. Like, I know everyone's trying to raise capital saying, look, no one's buying houses anymore. But I'll tell you, it's not that simple, because it's all cyclical. One day they're all going to be buying houses again. You have to explain to your investors why it's okay. And it is that people are moving out to buy homes exactly for the reasons, David, that you mentioned. So, David, this has been a lot of fun. Thank you so much for for sharing some of your story and some of the things you're doing at Maymont. And thank you for being on the podcast.
My pleasure. Thanks for having me, Jay.
And that's wrapping episode number 39 of The Rent Roll. Big thanks to David for being our guest today. Thank you to Waymaker, JPI, and Foxen for sponsoring today's episode. And thank you to all of you for spending part of your day with us. We'll see you next week.